The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and good morning, everyone. It's Ted Bader here with SIA Wealth. Thank you for joining our webinar. We have slowed down the webinars from weekly to probably every other few weeks, couple weeks, 2 or 3 weeks. But we thought this was an important time to do a webinar and address what we think are pretty important changes. And we're going to talk a bit about what that means. So the agenda today is I'm just going to do a brief introduction. Jeremy's going to talk a bit about some of the enhancements as a result of a couple years of R&D at SI Wealth relating to interpreting the signals that we get from SIACharts. He's going to talk a bit about that, how that will affect the BMO funds that we manage. And then he's going to give a market outlook, a brief idea of what he's seen in the markets, because not everything can keep on going up all the time, although they can keep on going up in the short term. We just wrapped up Q2. I did want to highlight a couple of things to a lot of advisors. We are wrapping up getting our commentary ready for the end of Q2 or end of the month. Those will be done probably by early next week, we're hoping. So you'll be able to see what was happening in the portfolios over that month, and to talk a bit about it. Anyone who's had any questions, and I have got a lot of questions on our Q2 performance as a fund complex. The reality is a lot of our equity positions did not perform as well as our peers. And I want to kind of really address that briefly. One of the reasons why is in Q2, our equity funds had positive performance across the board. But one of the reasons we didn't have as strong a performance as some of our peers is because we had zero equity exposure in our equity funds for the month of April, which ended up being quite a strong month. Now, as you guys all understand, 2020 has been quite interesting. Our equity action call got us out of the market early March. And by the end of March, we were completely out of the market with no equities, and our funds were performing very strongly because of that. They were still negative for the year because of the steep decline, but I want you to understand that because that V-shaped recovery happened in April and continued on for May and June, we did not get back into the market until the end of April, and subsequently we missed a bit of a rally. Now, I don't want to get caught in the fear of missing out, and I want us to understand why we're owning some of the funds that we own. In essence, it's a cheap insurance policy. If you look at what we had at the end of March, nobody knew what the response of the Fed would be, and nobody knew what the reaction of the markets would be. So we were out of the market taking that risk off the table. If I had taken a poll of the advisors on this call right now at the end of March, what are the odds of a V-shaped recovery? I think the poll would be 0. However, that's what we have. So we're trying to be adaptive. We're trying to follow along. I stress to you that it's not a function of whether we're underperforming our peers or not. It's about understanding that we are a tactical asset allocation fund, and we fit as a complementary sleeve for some of your long-only managers. And I reiterate that fact is at the end of March, we were basically a cheap insurance policy, because now for Q2, we've made money, but we did miss out a bit on that rally in April. And nobody really was expecting it. So when it happens, we'll take advantage of it as much as possible. But now I'm going to turn it over to Jeremy to talk a bit about what it is we're doing from an enhanced overlay point of view. And if there's any questions, feel free to type in your questions. We'll go to the Q&A after that. And if anyone has any other things they want to reach out to us, feel free to. Thanks. Over to you, Jeremy.
Thanks, Ted, and thanks again, everyone, for taking time to join our webinar today. It's a very exciting time for SIA Wealth Management. We've now moved through from the research and development phase over the last 2.5, 3 years into the execution phase with our partners at BMO Global Asset Management, and we're very excited to discuss those changes today. So a lot of the macro changes and the reason for these changes is driven by you, our clients, and also driven by some of the changes that have happened in the market over the last 6-7 years. So if we think back to 2016 with the unprecedented actions by the Federal Reserve, that really made quite a bit of a difference in the market, and we started doing our R&D getting into that. So I'll get into more details on what that is as we go forward. So First, our agenda here is why is SIA Wealth Management adapting its investment process? How is SIA Wealth Management adapting this process so that our funds will do better going forward? And then what changes are being implemented in SIAW Wealth Management's sub-advised funds? And then what does this innovation show us? So the first thing is the market is changing, and so are we. What is lost, I think, a lot of times when people think about SIA Wealth Management is that we're really a fintech business. We do our own research and development. I think most people know us from our relationship with SIACharts, and we do use SIACharts exclusively in our mandates, but we have also been doing research and development in our own business because things have changed. SIACharts was designed to be a service for investment advisors. It had to develop rules and processes that could work in an investment advisor's world and work with their compliance. It's a different world with SIA Wealth Management. We started our processes and our programs to mimic and match a lot of those strategies that were happening at SIACharts. But because we're in full prospectus funds, we are not bound by those rules. We're not bound by the same compliance. And we have a great partner with BMO Global Asset Management that is working with us and learning more about what we can provide. And we've done that. Major changes in what's happening and how the market reacts to things. Algorithms are out there. So there's other firms out there using advanced technology for investing, which is impacting the market at macro and micro levels. So we're seeing computer trading programs, high frequency trading, big data, daily millisecond trading, computers that are sitting in advance of orders that we put in on the retail and even institutional side that are there. So this has changed dramatically how the markets react on short-term basis. We see a lot more volatility in the market, and we have to adapt our technology and have adapted our technology to work within that framework. The real big one, the elephant in the room, is intervention. We've gone from an environment where markets generally were free and found their own bottoms and found their own tops to now where we have tremendous intervention from global central banks and global governments. So in 2008, we saw intervention come in to stabilize what was a significant financial crisis. In 2011, we saw additional measures in quantitative easing. In 2016, we saw the Federal Reserve notably decide to enact a strategy to devalue the US dollar. And then in 2020, we've seen unprecedented spending and support from central banks and governments around the world that just dwarfs anything we've seen previously in the past. So we've got to adapt, and we've got to have process that can now work within that framework as well. And then external factors. So we've got greater influences happening geopolitical. Certainly some of the Brexits, some of the crisis that's happening politically in the US, certainly some of the social issues that are being brought up almost on a daily basis now are having tremendous effect. And we, as a research and development firm, have been developing technologies to take advantage of and protect our clients from that. So, four-step process. The significant changes, the changes that we're enacting in our mandates are still following the same rules as we've always done. We've got the equity action call on top. We've got our asset class rankings. We're doing sector evaluation, and then we finally make investment selection. So we're just doing enhancements and overlays on each of these different levels from what we've had. So what does this mean in execution? When we get into the green zone, we are still bullish towards equities. But where the opportunity lies with being bullish towards equities is that we can now trade up in the green zone. So we can take a stock that we purchased that was at the top of the green zone, now has moved down to the bottom. Another sector has moved up higher. Stocks within that sector are doing better. We can upgrade within that environment. When we get to the yellow zone, we call this our transitional zone. So we can now, traditionally what we would have done if we had a stop loss within an individual security in the yellow zone, we would hold cash. We now have the ability to make purchases within the yellow zone. So the additional volatility that comes in the yellow zone creates opportunities for us where we can actually go on the bid for equities, so we can look to purchase that individual security that's ranked high at a better price. So just go in instead of just going after it as we traditionally would have done in the green zone. But also we've got a higher hurdle rate for investments if we're going to be making purchases in the yellow zone. So the relative strength needs to be higher both on an intermediate and a short-term basis. The reliability has to be stronger, and volatility measurements have to be there. We've also got in the red zone now, traditionally, we would either be moving to US or Canadian cash in some of our mandates, having a choice between them. There's now more currency products out there that are IPUs that allow us to purchase in a full prospectus product. But what we're also going to be adding here, which is most important, is commodities. So we'll have the ability to purchase commodities or buy equities that are sensitive to commodities within the red zone. So that position can go to a maximum of 40%. It's expected to operate in the 25% range. Largely what we're expecting to do in this area is to look at gold. With the last three negative market events, we've seen the Federal Reserve and other central banks add tremendous liquidity, and governments do tremendous, for lack of a better phrase, printing press activities as they borrow and put lots of capital into the markets. We have a situation where precious metals is generally a strong beneficiary of that. So next level we move into is our asset class rankings. What we're doing here is a little bit different than what we have traditionally, but it's going to be specific on mandate. So this is something that we're building out into the process right now for our mandates. But as an example, for the North American product, it does not have the ability to purchase international equities. So international equities does not necessarily have to be in there on that. We can look at adapting that universe using large mid-cap and small cap equities as different asset classes. We can use different asset classes such as real estate. So again, we now move away from a one-size-fits-all to the opportunity for us to look at each mandate and create an asset class rankings that is customized just for that mandate. Sector rotation, some key measures on this, reliability being a big part of it. So we look at relative strength, we measure the volatility of it. So as an example, if we were looking at precious metals as a sector that moves up into the green zone within the sector report, but it doesn't spend a lot of time there. There's more volatility with that. It's a shorter time measure there. We can now create rules around that where we can be shorter term in nature with that product versus comparing it to something very generic, which is, say, for example, internet, which has moved into the green zone and been very, very strong and reliable within that sector green zone. So we can now make an assessment of the reliability of that investment or that sector and make decisions on that when we're looking at some of our ETF and our individual security mandates. Weighting, so we can put higher weightings based on that reliability on that, and we can reduce weightings if reliability falls. So that allows us to move into a position and add to it and move out of a position slowly over time. It is all versus the all or none process that we've had recently. We also are going to move from daily or from a quarterly liquidity monitoring really to a weekly liquidity monitoring. So we're going to be monitoring that, and we can adjust our weights based on liquidity. So it's not uncommon in the market, and many of you, I'm sure, have experienced that, where you make a purchase and then later on the liquidity dries up and you don't want to be stuck in a position where that liquidity is not available when you need to move out of it. Upgrading, so we're able to upgrade. I mentioned this earlier in our conversation. We have the ability to upgrade from a strong relative strength sector to a stronger one. So traditionally, we would have waited for a yellow zone breakdown on that and a stop, or a red zone breakdown and a full stop on that position. We now have the ability, if we started off in internet, for example, and it was the highest ranked sector, and it moved to the lower end of the green zone, and we saw something like consumer staples move up to the top, we can rotate out into more strength. And our research has shown us that that provides additional alpha to the processes that we work with. On the individual investment selection, reliability, again, we're measuring that volatility, measuring those probabilities. So again, if we have an individual security that when it goes into the green zone, generally only spends 2 weeks or a month in the green zone, that's not going to get the same probability as something that such as Apple, which comes in and can spend 12 to 18 months in the green zone. So those types of reliability measures are now available to us. Upgrading, we're ability to upgrade from a strong relative strength stock to a stronger one. So again, not dissimilar to what we do in the sectors. We make a purchase at the top of the green zone. We can trade up in the green zone if that individual investment falls. So if it moves to the lower part of the green zone, doesn't quite hit a stop, we see this many times, but some strength shows up in another area, we can have the opportunity to upgrade into that, and that adds to alpha over time. We have the ability to buy and sell earlier, so we can make decisions and make those purchases over periods of time rather than doing an all or none process. That will help our trading efficiency dramatically for us to be able to have that as well. And then finally, the universe. So the universe report, traditionally, we would be doing a quarterly. We're now doing a weekly universe check. So those universes can be updated very, very quickly, and we can see dramatic changes in that universe. So we could hold a position when we look at relative strength, when we look at liquidity, when we look at volatility, when we look at other measures that we use in defining our universe, we could see positions that we hold in the portfolio being removed from the universe, and that gives us an opportunity to do an upgrade with stronger investments. So what does this all show us? I think probably what most of our viewers here today would be interested in is what we're doing with our equity action call overlay. If we look at the blue, this is our traditional equity action call. We've developed in-house only for the purpose of use with SIA Wealth Management, a shorter term overlay that we use in conjunction with the equity action call to show us. So we get red calls a lot faster. So if we look at the 2015, 2016 time frame when we had trouble in the fall, the late summer, early fall of 2015, we can see that we moved into our red zone. So this was a stronger warning signal to us, allows us to act faster. We didn't see that red equity action call until January 15, 2016, and remained in the yellow zone over that. So this is an opportunity for us on that short-term indicator to reduce our equity exposure or to move to less volatile sectors as an opportunity from there. If we look when we get a re-entry position in there, we have March 16th instead of March 29th. So again, those shorter term indicators that we've developed in-house at SIA Wealth Management can now be used to effectively get us out a little bit faster, get us back a little bit faster than our traditional EAC just used on its own. In 2018, 2019, we had a situation where we moved to yellow zone. For those of you who attended the webinars during that time frame, it did appear to myself as an analyst looking at the markets that this was not likely to move into the red zone, but we ended up in that yellow and in that holding pattern for that full time frame. What the October 24th shorter term EAC overlay that we used showed us is that in October 24th, we needed to reduce our equity exposure a little bit faster and then get back on January 2nd, 2019, where we didn't get back until much later in 2019 with the conventional equity action call. And then finally, I think 2020 being very important. We got out on March 12th, 2020. We had drawdowns in our market. Most of that, or a big chunk of that, came on the last day before we moved in the red. We only needed a small move down. It came off, but we still were out of the market. The market continued to deteriorate dramatically from that standpoint, and we got back on April 29th. What's important about the EAC overlay is that it was much, much faster. So again, looking at shorter term indicators, because of what's happening with algorithm trading, what's happening with intervention or lack thereof in the early stages of this 2020 COVID-19 crisis, we had a faster indicator that showed us the warning, and then we were able to get back in just slightly ahead in April 27th in 2020 is what this indicator would have shown us in our process. From here, I'm just going to move on to a market update. I haven't done one for some time. There has not been dramatic changes in the market, but I did want to use this as an opportunity to go over some of the things that I've been seeing as of late. So first and foremost, debt and reallocation continues to drive the markets higher. We're still seeing indexes doing extremely well. This is largely, in our opinion, on the backs of global monetary and fiscal measures. The printing presses continue to pile up, and there is not seeing, at least in the near term, any changes to that. So in my opinion, the governments are just continuing to look at this as a debt servicing problem rather than a quantity of debt, and they're willing to make those enhancements and do those support and liquidity into the market. Also, there's been little or no oversight of spending by opposition parties. For the most part, we certainly see it in Canada. The opposition parties have been delegated to the outside realms of Parliament. They don't really have the voice there. So a lot of this spending is happening. We're going to find out with the update presumably today where some of this spending has been going and how it's going to be. And then I think what's also important is that we may be coming to the end of the bond and the real estate markets as big areas for investment by institutions and by individuals. So the bond markets are clearly have been under duress during the COVID crisis, but the low interest rate environment that we have creates less and less opportunity for bonds to give you positive returns to compete with inflation in many portfolios. We've talked to many institutions that are interested in our process and using our process that are making dramatic changes to what their bond allocations are. And I think even more important is real estate. So we're seeing structural changes to how real estate is going to work going forward. COVID-19 has, I think, shown many businesses that the dependence on real estate for their employees may not be as necessary as they might have, as many firms have gone to work from home. So these rotations are expected to take many, many years, and a lot of flows are moving out of those, in our opinion, into the equity market. So what's happening on the pros and cons? There's been a surge in the stock market since we've had some economic openings, and that the top graph here shows us that consumer spending surged dramatically in May. So this is from the U.S. Metrics, and we can see that there's been tremendous consumer growth and spending over that time frame. Has it equaled what was lost in the 2 months before? No, but we're seeing that increase, and so that it appears that some pent-up demand is being unleashed by consumer spending as we reopen. On the negative side, on the con side, we see the COVID-19 cases. When I did this chart back in early June, we saw a downward trend. The red line here, the highest line on the graph, shows the U.S., and certainly they've seen some tremendous upward movement as they've reopened their economies and as people get together. So certainly sits as a strong risk point for the market, especially when we see a market as big as the U.S. under such tremendous pressure. With all that in mind, though, the equity action call continues to improve. We've moved back into the green zone, and as such, we are bullish towards equities. We've been taking advantage of that and had our portfolios at their strongest levels. I've got on our asset class rankings, June 2nd, the middle chart here. This was the last update that we did. We do see some changes between then and now. We have U.S. equity has moved into the second position, displacing cash into the third position. Canadian equity is still, stubbornly been stuck in the fifth position on our asset class rankings. We did see some improvement on bonds. Bonds moved up into the sixth position. Largely, this could be seen as the bond market being oversold from the COVID crisis and rebounding that with some of the support that's being given by central banks and governments around the world. So looking at a chart that I did in our last update, we had the SIACharts market equal weight index versus the cash equal weight index. Equities continue to move up. We did see a drop in late June, a couple of surprise negative days there where we moved down right into the early part of July, but we've now seen that rotation move up. So this is an important chart for us. We're watching this extremely closely. If we see a material rotation back down, this could be an early warning sign on some potential problems within the equity markets. But the breadth in the market, is it explosive to the upside? No, it still is a bit of a narrow market, but we are seeing cash flows move positively into equities away from treasury or money market products. International equity remains our #1 ranked asset class, and looking at this chart, it hasn't been an extremely dominant performer going forward, but it certainly has been the most consistent of the equity asset classes. It moved through resistance recently, so that 33,690 level, it moved through. So we've seen some improvement since June. It's moved up about 4 boxes since we last did our update here. So there has been movement in this, and it really is now on a resistance level, looking at the highs of 2020 as its next resistance point. So we're watching that one very closely. U.S. equity is ranked #2. It's actually reversed down. We're a little bit more concerned about this equal weight index because we've got a negative S max on it, and we're sitting in a column of O. So is this mean that there's intermediate term problems? No, but it really is highlighting that the breadth in the U.S. market has started to weaken as of late, and a number of other charts that I've looked at are showing and suggesting the same thing. So this is one for us to watch for. It's still outperforming cash, so it is still seeing positive money flows going to the U.S. It just appears to be getting narrower and narrower within that marketplace. So we'll watch that closely for any concerns there. Canadian equity, I've mislabeled this, is currently in the 5th spot within the asset class rankings. Never really got its legs under it during this crisis and the outcome. Certainly the index has performed well, but it's always largely remained more narrow than what we saw within the U.S. and the international markets. Got a negative S max, reversed down. So we're looking to see this one make a breakout up above that downtrend line that we see. Still underperforming short-term money market on an equal weight basis. The cap weighted index has obviously shown some pretty good results, but the underlying pinnings of the Canadian stock market has not impressed us as much as international in the U.S. So where are we looking for strength? Specific areas. We're going to be narrow and focus on where we're looking. International equity, we're looking at China. It recently went above resistance, so it's hitting new highs there. This is obviously China being a major contributor to the global economy, but it's also the starting point, the epicenter of the COVID-19 crisis. They did their shutdown. They appear to be coming back online with their economy faster because they've been at it for a few more months than the rest of the world, the Western world from there. The chart shows us a pretty good risk reward. There's still upside in this. I'm looking at the BMO China Equity ETF ZCH, trades on the TMX. So it does show a good risk reward. A pullback here would not be completely out of line back to that first support level, but again, our risk reward looks positive for us. Also looking internationally is Europe. So the BMO MSCI Europe High Quality ETF, again, is a position that we like. Further along, again, in the COVID-19 shutdown, Europe was hit far sooner than what we saw in Canada and the United States and in South America. The chart again shows a good risk reward on this and continues to move positively for us. Looking again within a narrower market now, the sector weightings or sector rankings are going to be more important. From our June 2nd update or June 3rd update, we haven't seen a change in what the composition is. We've just seen a change in the order. So computer software, leisure, electronics and semiconductors, health services all remained in the 1 through 4 positions. Metals and mining moved down to the 8th. Drugs moved down a position. Automotive moved down to the bottom, or moved up a little bit from the bottom position in this ranking. So again, this is where we want to focus our attention going forward. If we look at computer software, since June has gone up about 5 boxes on a 2% chart. So good opportunities have been there. It's ranked #1 in the sector report. Just took out additional resistance at the 11,200 or 112,000 level. So that's positive for us and gives us more upside potential on this. And we still see it as a good risk reward. Looking a little overbought, but still a good risk reward from where we see it. Electronics and semiconductors sitting right at resistance, moved up from the June call that we did, pulled back in July, and now retesting those June highs that we've seen there. So again, potential upside in this sector is good. A breakout from here could see we would add another resistance level above in sort of that 55,000 range. So really good, again, risk reward from a technical standpoint. Again, a little bit overbought, as most sectors are these days, but a good narrow focus for us to look at. The SIA Internet EWI ranks number 5, just moved into all-time highs that were in June of 2018. So that's a positive for this chart, for this sector on a technical basis. Upside potential, it looks reasonably good. A risk reward, again, looks positive on that. And then finally, drugs. Drugs are currently ranked in the 7th position. They moved out of the gate early on in this COVID crisis, hitting new highs in May, above their levels of 2020 or earlier highs of 2020. Makes perfect sense given the drive for vaccine for COVID-19, as well as future treatments for people that have that. So again, a good risk reward on that. With that, here's our product lineup and the ways to purchase it. We're going to just open I think Ted's going to read out any questions that might have come from you over this.
Yep, we had a couple questions come in, but if there are any more questions, feel free to type them out in the question tab and we'll get to them. One of the questions is, what is the shorter term indicator that increases the sensitivity of your EAC? So is it one single indicator? Do you want to let us know the secret, or what is it made of, I guess?
Well, we're gonna keep that in-house. We certainly want to maintain our competitive advantage in our research development. It is designed to be a shorter term indicator, and we have developed new tools at SIA Wealth Management that don't necessarily exist at SIACharts. That's going to be a continued theme as we develop technology for full prospectus mandates as we run with BMO Global Asset Management going forward. So, I think the one suggestion, we certainly want to help our clients at SIA Wealth Management, and as we develop these technologies, our top supporters will certainly be brought closer into the fold as far as these technologies and potentially find access for the rest of their book of business as we continue to develop them. So we do see this as a partnership. We want to share and we want to be helpful, but again, we want these products to perform well, and we obviously need your support in these products for us to continue to develop new tools and new strategies for you.
Okay, so a lot of this testing that you've been running on the portfolios, is it any of it live, or is it all just hypothetical?
Great question. None of it has been live until just recently in the last couple of weeks with the BMO Global Asset Management products. We have run an institutional product in-house since October of 2019, which performed very well using these strategies over the 2020 crisis, the COVID crisis. So we saw significant enhancements in performance and enhancements in drawdown over that crisis. So these strategies were not ready, just unfortunately bad timing. Pre-COVID, we had anticipated working with our partners by the end of March with them. The institutional client was willing to go with them early on and receive some benefit from that. So again, we do have this in real world, and we have been working on these improvements now for over 3 years. So ever since that 2016 downturn, we had been working towards getting this done. Just bad timing where our March 31st launch would have been very, very timely if COVID came after that.
So that's a follow-up question, is currently those enhancements are being, they're being used in the BMO funds, correct?
Correct, yeah. So we've worked with our partners very closely. We made we had an understanding, and it was my recommendation that we wait until we reach the green zone again before we launch these enhancements, just so that we didn't have any confusion during the red zone or any significant changes. But these changes have been started being implemented into the products at BMO Global Asset Management over the last couple of weeks. So as we move forward in time, you're going to see those enhancements in the performance that goes in the products.
One of the questions was the overlay is specific to SI Wealth and the funds we run for BMO. It doesn't affect the equity action call on the SIACharts system. And Jeremy will clarify, but we're not creating a different EAC. It's just an overlay on the existing one from SIACharts, which doesn't change.
Correct. Yeah, the SIACharts equity action call will not change. There are current, we've been doing a tremendous R&D at SIACharts, but again, that product lineup was designed for a retail investment advisor to execute with. At SI Wealth Management, we have to differentiate because the products that we develop are used, by investment advisors, and we have a lot more flexibility within our mandates in a full prospectus. But again, this is just an overlay. The equity action call has not been altered in any way. And that's not to say that it won't be in the future at SIACharts. That's a different product altogether. But we're just using an in-house overlay that we've developed specifically to combat some of the issues within the markets and the opportunities that are now within the markets to improve our mandates with BMO Global Asset Management.
Okay, a couple questions came in on will these overlays and these changes such as reliability or upgrading, will they result in a lot of increased trading or activity in the BMO funds?
Yeah, great question. Yes, the simple answer is yes, there is more activity in the mandates. It's not tremendously so. There will be times when it's more than not, and there will be other times when it is exactly the same as what it was before. But we now have the ability to do upgrading within the green zone, do purchases in the yellow zone, do some purchases in the red zone in the commodity space, largely going to be focused on gold. But those opportunities will result in more transactions, but not to a level that would be, if our current turn was 1.5 times, it would not move it that much higher than what it already has been. So great question, but again, we are sensitive to tax issues when we were doing our R&D and really just focused on those nuances in the market when you're moving into crisis, overbought levels, really just looking at a lot of the measures that we've implemented are to really test an investment before it goes into the portfolio to make sure that its reliability is higher. And part of that was to reduce whipsaws within individual positions, things like that. So I think there'll be some effective changes that will result in more transactions, but you'll also see some unneeded transactions potentially being avoided by the new strategies as well.
Okay. That's it for the questions that came through. I hope we covered everything that was necessary. And if there are any other additional questions, feel free to reach out to anyone from SIA, and we're more than happy to help. We also will have copies of the presentation available afterwards. So, Jeremy, I'll leave you to wrap it up.
Yeah, thanks, Ted. Really thank everyone for taking the time today. I can't tell you how excited I am to have these changes implemented in the BMO products. We've got a great partnership with them. We've got a great partnership with all of you, and I believe that this will be a strong enhancement to our product lineup and help you deliver the results that your clients are looking for. So as Ted mentioned, we're available for any Q&A on an individual basis if you need it. Myself, Ted, Jason, Paul, Kyle, the remainder of the team are available, and we will continue to do updates and update you on information. We are just finalizing our quarter end results, and there will be some commentary coming out in these results talking about some of the changes that we've made already in the first couple of weeks that we've been executing with these strategies. So thanks again, and have yourselves a great day.